Sell now as the housing market is about to crash. I'm your host, Steven Van Metre, and thanks for joining me today. And insiders are starting to warn of a slowdown in the housing market that could lead to an imminent crash in prices. And as you know, when insiders start to warn, the situation is actually much worse than they're saying. Let's however pick up today's story that the housing industry insider warns that the market is seeing signs of a real slowdown. The National Association of Home Builders warned on Wednesday that soaring inflation and higher mortgage rates are slowing home sales, with CEO Jerry Howard calling the combination a perfect storm. Howard said on Wednesday that the cost of capital has increased for consumers and builders alike. He noted that the cost of labor remains high, as does the availability of labor. The cost of building materials have gone up a whopping 19% year over year. And Howard pointed out that traffic at our job sites is down below 50, and on an index of 50 is the equilibrium. That is actually not good. I'm afraid it's a sign of a real slowdown, he said, noting that housing leads us into recession. And actually, it's the other way around. Housing actually is one of the lagging indicators. People often ask, Steve, do you think the housing prices will come down and interest rates will eventually come down because I want to still buy? The answer is yes. Housing is always one of the last shoes to drop. And when housing starts to go, it already is an indication that everything else in the economy and the market is much worse. Let's dig deeper into this sentiment survey as U.S. homebuilder sentiment falls to a two-year low on softer demand. The U.S. homebuilder sentiment slid to a two-year low in June as rising inflation and higher mortgage rates weighed on housing demand. The National Association of Home Builders gauge decreased 2 points in June to 67, the lowest level since June 2020, figures showed. That marked the index sixth straight decline. And here you can see the National Association of Home Builders Housing Market Index. We can go all the way back into the 90s, where you see as it peaks and rolls over and heads down. There was a soft recession in 94. We see the housing market was strong and pulled back. You can see going into the dot-com bust, the housing market didn't take a big hit, but the great financial crisis here, it came shooting straight down. And now we're seeing that same type of pattern where it rallies higher and now is starting to head lower, suggesting that things for the housing market are about to get much worse. And the housing market faces both demand side and supply side challenges, as residential construction material costs are up 19% year over year, with cost increases for a variety of building inputs. On the demand side of the market, the increase for mortgage rates for the first half of 2022 has priced out a significant number of prospective home buyers. And we've talked about how higher rates, get rejected, and that's how we know that interest rates are likely to head lower. And many people still believe that we're in this new regime of higher interest rates. It's important to understand that in a debt-based economy, money is created when people borrow from the commercial banking system. And so the only way higher interest rates can be validated is if people want to borrow at higher and higher interest rates. So one of the reasons we look at, say refinance applications every week, which actually ticked up a little bit for the first time, is it shows that demand for large loans and large creations of new money into the system are falling. And that's not what you want to see in an environment to sustain higher interest rates. If anything, it tells you rates are about to head the other direction. And when we see a big rapid move higher interest rates and we see demand start to fall, well, we understand that that means for the housing market, bad things are coming. And here you can see the 30-year fixed mortgage rate. And for most of you, if you've been in the housing market, owned a home at all in your lifetime, you've never probably seen rates go this high up from a low level this quickly. And that scares home buyers. People chase it up, and then they turn their back and say, I can't afford it, I'm out. The group's gauge of prospective buyer traffic fell 5 points to 48, the lowest since June of 2020. The measure of present sales also declined to a two-year low, and sales expectations for the next 6 months dropped to the lowest level since May 2020. By region, and builder sentiment declined in 3 to 4 regions, and sentiment only improved in the Midwest. And a separate report earlier this month showed 69% of construction firms reported few or no qualified applicants in May, according to a survey of small businesses. And now we can kind of turn back to the recent FOMC meeting that we talked about on yesterday. And what did we hear from Fed Chair Powell? That he wants to bring demand down, including that would be the housing market, because he said the labor market is too tight. And this is another example where they just can't get enough labor to build homes. Well, how do you fix that problem if you can't get enough labor? well, you can bring demand for new homes down, and that's what the Fed's going to do. Let's continue on, because Redfin and Compass are laying off hundreds of workers, something I've said will happen. The layoffs will start in the housing market. We started to see in the mortgage market some layoffs already as housing market cools off and inflation spikes. In a blog post, Redfin CEO Glenn Kelvin said his company is laying off about 470 employees, or about 6% of his workforce, after the demand in May came 17% below expectations. We raised hundreds of millions of dollars, so we wouldn't have to shed people after a few months of uncertainty. But boy, that didn't matter, as mortgage rates increased faster than at any point in history. We could be facing years, not months, of fewer home sales, and if Redfin still plans to thrive. If falling from 97 a share to 8 doesn't put a company through heck, I don't know what does. And meanwhile, Compass confirmed to USA Today in an email the firm is letting go about 450 people, equating to 10% of the staff. So it's notable that housing prices are one of the last shoes to drop, but the layoffs actually start there. Again, we start to see them in mortgage origination units, and then you start to see them moving into the builders and other associated kind of employers in that landscape. And now, what does that mean? Well, we're starting to see today the demand is headed lower. U.S. housing starts declined to the lowest level in more than a year, as May construction fell to 1.55 million pace after the April surge, as builder backlogs remain elevated even as sales decrease. And residential starts declined 14.4% last month to 1.55 million annualized rate, the lowest in more than a year, according to the data released today. The median forecast called for a 1.69 million pace, and April construction was revised sharply higher to 1.81 million rate, which was the strongest since 2006. So we see a big move higher in April, only followed by a big move lower in May. Kind of guess where this trend is going to start to head as higher interest rates and tighter monetary policy start to impact the housing market. The monthly decline starts was the largest since April 2020 and suggests residential construction is coming under pressure as higher mortgage rates take an even bigger toll on demand. And still, with the pace of building permits exceeding starts, home building in the near term may hold up. And there's the optimistic view of this. Still, builder backlogs remain elevated. The number of total of homes authorized for construction but not yet started rose 0.7% in May. The number of single-family properties under construction was unchanged from a month earlier, at the highest level since 2006. And at the conclusion of the Fed's policy meeting, Chair Jerome Powell indicated that home prices may slow to cool given the limited number of properties on the market. And there's a tremendous amount of supply in the housing market of unfinished homes, whereas the inventory of finished homes for sale is incredibly low, historically low, so still a very tight market, Powell said at his press conference. Prices might keep going up for a while, even in a world where rates go up. And that is actually something that's not likely to persist too much longer. Again, we see that housing is one of the biggest lagging indicators. Now, if you're concerned what another housing crisis could mean to your portfolio, well, you shouldn't be. I'll put a link up here to Portfolio Shield in the corner and the description below. Give it a check when you have a chance. Because what we understand about the U.S. economy and the housing market is something that we've talked about, and I've shown you charts, but just to put that all together without showing you a bunch of charts today, it's all a function of the stock market. The U.S. economy is driven completely by the equity market. That's why you see when the stock market starts to go down, GDP heads lower, and why we're likely to see a negative print for second quarter. It means as stock market goes lower, interest rates start to fall. And why is that? To create demand. People actually need demand is created when rates fall, not when rates rise. Why does the housing market go down when the stock market goes down? It's the wealth effect. Same with retail sales, same with crude oil, same with all other indicators that we look at. It's all a function of the stock market. And right now, a lot of people are concerned the bond market may be kind of in an actual trend of going higher for the first time with a secular rise and perhaps after the secular decline in 40-year rates, that perhaps we're in the beginning of a secular rise, and possibly that's due to foreign institutions and countries selling? Well, not so much, because just because something goes down for 40 years doesn't actually mean it goes up for 40 years. There's really no relationship there. But a lot of people were worried about Japan selling treasuries. Well, it turns out they've been buyers. Let's over at Goldman Sachs now, which has a piece on the tick data of foreign investors' net purchase long-term treasuries in April. Wait, net purchased? That actually doesn't make sense, considering most people see as net sellers. Based on our valuation-adjusted estimates of preliminary data from the U.S. Treasury, foreign investors net purchased long-term U.S. securities in April on net inflows from both the private and the official sector. Foreign investors net purchased long-term treasuries, U.S. agency securities, and equities, while net selling long-term corporate bonds. Flows across asset classes were largely driven by foreign private investors. At the country level, our valuation-adjusted estimates suggest Japan was the largest net buyer of long-term securities of U.S. Treasuries, while China was the largest net seller. At the regional level, Latin America, Europe, Asia all net purchased long-term Treasuries. In Europe and Latin America, flows from the most countries were neutral to positive. Switzerland was the largest net long-term U.S. Treasury buyer in Europe, while Brazil was the largest net buyer in Latin America. And that certainly throws a little bit of caution to the wind of everyone trying to get out of the Treasury market when foreign investors start to buy. It's because they already know that disinflation and deflation coming. Remember, they see it first. Where things are produced, they know where the slowdown starts to happen. They know where it's eventually coming. And when they start to buy, it's an indicator of what's coming to the U.S. because something else that is coming, and we're just starting to see the early signs of it, is higher unemployment, and that too is correlated to the equity markets if we looked at before. But listen to today's data from the unemployment insurance data. We see initial claims drop just a mere 3,000, a positive sign that they fell, but are still holding now around the low 200,000s at 229. Look for that number to continue to go higher, and then all claims of a bull market will be ending. We will be headed then into recession. Total claims down 1.4 or 1,400, down to 1.28 million, and a sign that workers are still able to get jobs after losing one, but that trend is starting to slow. And from the Fed's perspective, that's a good sign. But when now we see that housing market insiders are warning, perhaps the peak is almost in, and for the economy, that's really bad news. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.